To the year-end and book closure series, year-end compliance. So today we have accounting standards and we have a speaker CA Vikram Udupi. So I request CA Kavita Chairperson, Bengaluru branch to escort the speaker onto the dais. And hand over a book. I request CA Kavita Parmesh to give the welcome address for the gathering.
Good evening and Shubha Sanjay to everyone. So this entire series, we are coming out with a series of study circle meetings on the compliances which are very critical from the closure of books for the year end. So we have planned 3 series, which is right now what today is going to be on the accounting and the accounting standards. From the accounting aspects, what all should be taken care and how the accounting standards impact them. The second one will be from the income tax perspective as well as from the GST perspective. What are the compliances which will have to be taken care of at the year end? And the third one is from the Companies Act perspective. Right now, these are the 3 series. Very important from the compliance perspective, so therefore we thought that now that when we are closing the books, this is the right time to have this session. And when we requested Vikram, CA Vikram for this, he agreed and he is here today. He is going to address us on the accounting standards. I welcome you, Vikram, and thank you for being with us here. Also, we are coming out with a couple of other programs for this month. In the Companies Act, when we are covering, we are also covering on the CCFS, the scheme, amnesty scheme on company law, which is there on the annual returns. That will also be covered. I request all the members to register and take advantage of this. So it will be, most relevant, and also look at where all the schemes are, which are clients where this benefit can be availed from your perspective also. And again, I welcome you all and have a good learning today. Thank you.
Thank you, CA Kavita. It is my pleasure to introduce today's speaker, CA Vikram Udupi. CA Vikram Udupi is a fellow chartered accountant. He specializes in Ind AS, IFRS, internal controls and financial reporting advisory, playing a key role in strengthening the firm's assurance and advisory capabilities. With over 12 years of experience, Vikram has led statutory audits and governance-driven advisory engagements across sectors including IT and ITES, financial services, manufacturing and several other industries. He has extensive exposure to listed entities and large groups with expertise in board level presentations, audit committee interactions and group reporting under Ind AS, IFRS and US GAAP. He is also actively involved in thought leadership as a speaker at ICI and other professional forums, a contributor at ICI's Ind AS educational material and a trainer for C&AG officers on financial reporting frameworks. With this, I present before you today's speaker, CA Vikram Udupi. Over to you, sir.
Good evening all. Thanks a lot, madam. Thanks to madam and Shripad for giving this opportunity to be in front of you all. And it's again, am I audible? That's fine, that's fine. Yeah. So 1st April or 31st March is 1st April or 31st March is always something special, and I'm happy to be here in my alma mater and talking to you all on 1st of April, which happens to be a starting day of the financial year. So like there were some puja happening at office, and this is the first year I am not in office when there is a puja which is happening. And I felt being in institute is something which is equally more important, and sharing the knowledge or learning new things from everyone makes things little more interesting and makes the life more productive. Keeping that in mind, and also thanks to Institute for giving this opportunity. Last 1 week, if I need to tell, we have been running around. We have been running around for multiple things. It's not just Vikram. It has been various members in my office. Fundamentally, one thing, we all follow cash system of accounting, and it's important that we collect cash. All the invoices which we have raised, to what extent we could collect. It has multiple things. One, to what extent we have grown. And second, we need to sustain. Unless there is team working with us, we cannot sustain, and we should make sure that we pay enough incentive for them so that they'll be continuing with our organization. And with lots of things changing, it may be the artificial intelligence coming, it may be the kind of business models which clients or companies work. You have been seeing the biggest change which I am finding it, rather I am also getting little concerned about the way books of account look. Any of you, any idea which is that particular law which is going to drive or which is going to impact companies a lot for the financial year ending, rather company or entity rather, for the year ending 2026 March? There is a big amendment which has happened, and it's gonna impact the books of account. It is the labor code. There has been a new labor code which has come effective November 21. There have been lot of discussions happening. It has been there from last 4 years. People have been talking about labor code. They all said labor code will be more simplified. They all mentioned all other related acts will get consolidated to make a labor code. I was also expecting things will be clean and things will be clear, but unfortunately the way it has come up, there are a lot of confusions. At least for me there is confusion, and if I need to read the specific law, it is little challenging. On one hand you have the act which has come, but the rules are still pending. It was open for feedback until February 14th. After that, we are not sure what is the current status. Thankfully, the income tax has come up. It has been, the act has come, but labor code, we are still in the confusion. Basically, what we are talking about is how do you compute gratuity? Imagine you have been computing gratuity for all these years. You have employees at various levels. There were employees who have worked for less than say 4 years or 5 years, and who have worked for long number of years. And you had a specific CTC, or rather gross, which was defined. So what today the law tells is, it has given couple of between A and I. Those are the exclusions which they have mentioned, and there they said these are the line items which is essentially the leave, rather travel allowance or the gratuity part or the retention, the redundant cost. Those things are specifically excluded from the wages when you compute the gratuity. And what we are finding it difficult is, majority of the companies in Bangalore are software companies or someone who are involved in IT and ITES. They have a peculiar line item called a special allowance. Now the question is, if at all there is a special allowance, should we consider that while computing gratuity? If you read the law, unfortunately, there is, I don't say there is no clarity, but there is some sort of confusion. The wordings which they have used is, all this exclusion together should not be more than 50% of the total salary. the intention, which in my interpretation or going by substance, intention was for the entities, if their basic was less than 50%, they wanted to make it 50%, and but the way they have mentioned is exclusion list, if it is more than 50%, it will become part of the wages. Now imagine you have 40% as wages, or rather basic, and you have a special allowance of 30%. Should we accrue gratuity on 70% or should we restrict it to 50%? This is the biggest question which we are having, and at this moment there are lots of confusion. Similar way, effective April 1, which is today, it's a new Income Tax Act. The sections have changed. The way, yeah?
I just had a question that I think a lot of folks are mandating the quite changing basic component from what it should be, but that's not something practical. And the system does that, then there should be no.
That was the thought process, sir. But the catch there is, if you read the definition, in that they have said what is wages and what is excluded for computing gratuity, which is other than wages. And in that they have specified 6 or 7 items. There they are not talking about if wages is, if rather basic is 50%, I am fine. That word is not there. That is where the whole confusion. Even though what you are telling is right, if basic is 50%, I need not to bother about special allowance. That is the thought process. But unfortunately, it is not there in the law. Even if I go and ask the legal guys or labor consultants, no one is ready to give in writing, telling you are understand. This is the understanding, because they are telling the rules have not yet notified. I am not in a position to give this in writing. So imagine 31st March you need to close. How do you close? And when do you expect these rules to come? And even though if rule comes, can rule override section? Section is very clear. They are not talking about 50% basic. They are talking about what are the other stuff. So how do you bring a rule to make this clear is something which even I am thinking. But substance over form, what you tell, or rather I don't even use the word substance over form, intent of the law is you need to make sure 50% is the basic. But has it come in the law is a separate question. And I was telling about income tax, few things which we have started telling our clients. We have also started telling our own teams. Understand, it's a simple thing. You need to have a list of all the sections of previous Income Tax Act, then trace it with the new Income Tax Act. Section 192 would have become something else. Section 917 would have become something else. Try to trace those. Fundamentally, what we have understood, which is told by even the experts, nothing much has changed. Everything remains the same, but the way you maintain the books, assuming you are in ERP and you have drawn something as section 194C, now you need to change it. It has to be the revised section which talks about 194C. And another thing which has changed, which is going to impact few of the companies, especially in Bangalore, the way Form 3CEB was before and what it is going to be there. In Form 3CEB, based on my initial screening of the format, it looks like couple of things which were part of the TP documentation before is going to appear on the 3CEB certificate, rather auditor certificate. So you need to be little more cautious. You need to be little more clear about what kind of documentation which is coming in terms of the auditor certificate is concerned. And why should we be concerned, or rather why are we giving more importance for year end as such? Imagine a scenario that there is a company and there is a CFO who is responsible for getting the books of account closed, and you have multiple things. Imagine it's a manufacturing company where production is happening at one place, the sales are happening, multiple division sales, like there is a sale which is on FOB, there is a sale which is on CAF, there is a sale which is happening outside India. We have been seeing, because of this Middle East concerns, the ships, especially the cargo, are not able to reach the destination, right? And the biggest challenge as an accountant / as an auditor is, whenever we do revenue recognition, whether if the terms of the sale is the material should reach the customer, then the first question comes, I would have raised an invoice and would have reached near the port, but it has not reached the destination. Should I consider it as a revenue? That's the first question which comes. Similar way, when you are closing your books, there could be certain questions on inventory valuation. You would have done inventory verification as on 31st March. Some delta exists. Maybe a scenario where you had trade receivables in the books of account. You had to create provision for bad debts. Some estimation has been done and the pressure is there as on 31st March to close the books. Majority of the companies where we do audit, invariably they will be subsidiaries of parent who is outside India or subsidiaries of other entities which are again in India. So it may be three types of things. One, you are a subsidiary of an entity in India, subsidiary of an entity which is outside India, or a standalone entity. If you are a subsidiary of an entity which is outside India, there will be so much of, rather there will be a clarity as to by when should you close your books. In our language, we tell T plus 5, T plus 7 or T plus 9. So what exactly we mean is T is considered to be 31st. From there, 5 days or 7 days or 9 days. I have only those many days to close my books of account. And imagine if it is 5 days or 7 days, by then I should make sure I receive all the sales related documentation. I receive all the details about trade receivables, to what extent trade receivables are good or going to be bad. We should also have the confirmation about how much bonus I need to pay. We should also have confirmation about any possible legal litigations which is going on. In this 5 days or 6 days, it is little challenging for us to collect all the information. So as on say 3rd or 4th of a particular month, the subsequent month, the company will say, I know there is a challenge in inventory. I can keep around 5% as provision for obsolescence and let us close the books. I know there is a revenue invoice which was done. Ship had moved from the port 1 month back and I presume it would have reached the customer location. Or there is a wire transfer which is being done by me for a foreign vendor and the wire transfer is completed, so I will be accounting it as a payment. These kind of things would have happened, and in the pressure the company would have closed the books. Then comes audit. Fast forward 2 months or 3 months, you are there in the audit. The auditors have come or the consultants have come. You see the books of account, the revenue what you had accounted. Maybe unfortunately, I have seen in few cases, those who have worked with automobile ancillary industry, right? You may be manufacturing certain automobile retail related products, and these products have to reach say United States of America, and there are certain OEMs which are there in USA. Let us take an example. There is a big OEM who is supplying to Ford Motor Company. The way they work is, I will tell you what is my plan, what are the designs which I am going to sell it to the customer. I will tell you when I need the product. At that point in time, that product should reach my location. So what these India companies which do is, they will have one warehouse in the United States, and that warehouse will stock all these items and it will be sold to the customer when there is a request from the customer. How it happens in my books, who is in India, I cannot transfer or I cannot move the materials outside my premises or outside my customs house unless there is an invoice. That invoice is essential for me to get shipping bill, right? But is it a revenue in my books? it can become revenue in my books only when customer accepts the materials. The way it works, I will move the materials from, say, Bombay port. It has to sail through the water. It has to reach United States of America. Generally it takes 2 months or 2.5 months to reach that place. And after it reaching, it will be there in the warehouse for another 2 months or 3 months. In this case, what are the challenges which I am facing? One, definitely the challenge is, how do I recognize the revenue? I would have raised a invoice, but it is not a commercial invoice. I should make sure in the year end that revenue is reversed. Once I reverse, there are a lot of compliances which happens. I would have given the details. Of course, there may not be any risk of GST per se because it is against an LUT, and there could be various other risks which I am going to run. Any idea what is the other risk which I am facing here? The biggest challenge which I will face is, once I make the sale, within a specific time, I should collect the money from the customer. Now, for me to substantiate, customer will not pay the money until my products have reached his location, and this whole stock of mine has moved from my plant to my warehouse, and it should not be a revenue as such. So 4-5 months it is sitting there in my warehouse. How do I go and explain the AD banker? For AD banker, I have raised an invoice. I would have supplied the details to the AD banker because it would have gone to the customs department, and at customs the details have been uploaded and the AD banker gets the details. So I have another challenge in terms of FEMA. Then the third one could be, how do I reconcile the books of account? Imagine this is a scenario where I am selling my products to one of my associate enterprises who is outside India. I might have shown it as a revenue, but he will not show it as a revenue. There is a delta in the case of closure of books. So like this, there will be lot of, one on revenue. On the second thing could be, I would have decided when I close the books, X number of debtors is definitely going to make the payment to me, but auditor comes after 3 months. Even then, the payment has not happened. And the question could be, how do you compute expected credit loss? So when I say expected credit loss, it is more from the Ind AS side. Under Ind AS, the kind of buckets which we create as far as credit losses is concerned is different. And the same thing applies more or less in the AS. We do provision based on the estimation. As on 31st March, you have not made a provision, and the auditor comes. Auditor will expect the company to make a provision. How do you demonstrate, or how do you explain this to the group company, or how do you explain it to your shareholders or the board? Again, that issue will come. Maybe third one could be about the foreign fluctuation. Foreign fluctuation entry would have been passed based on the customs rate. The auditor will come and say you need to account as per the actual spot rate which you could have considered, whether it is TT buying rate or a TT selling rate. So in all these things, it is not that the account closure was incorrect. The only thing here is it was not appropriately planned. It was not appropriately scheduled as to when should you have a cutoff. Post 25th March or post 26th March, I don't make any sale, or all the payments in my organization I do by so and so date, so that all the payments will reflect in my balance sheet or in my bank account. I have a proper debtor listing which happens on a day-to-day basis, so that in the year end I don't have any challenge. And if I am able to bring all these activities in my year-end procedures, then it is possible that the delta between the 31st March date versus the date of audit can be reduced. So today we are trying to deep dive in few of the cases where there could be certain challenges as far as auditor is concerned or as far as the accountant is concerned. Yeah.
There is a practical business need to continue making sales, right, till 31st March. So if you tell this to business leaders that, hey, because of complication in accounting standard, we need to cut off on 25th March, it will not sell. So in fact, in India, the mentality is that, buy towards the end because you get more discount. So
halt. Halt is different, cutoff is different. So when I say cutoff, what I mean is, you know, if at all it is an export invoice, you know the shipping will take, rather it could be air pick or various other days, you know that if it takes 6 days, meaning whatever sales I have done post 26th should not be part of my revenue. It will become revenue only on April 1st. Whatever was done before 26th is actually my revenue for the year. The way you define your books is in such a way that you are giving the T plus 6 days for revenue recognition. In any of the ERP, you can do the cutoff. The entry is getting posted, but the GL will get hit only when the destination is reached. If you are able to do this cutoff, and the same way it can also happen in terms of, say, even consumption. For example, WIP, I'll tell you. There could be certain things. Imagine you are a multiple product manufacturer, or rather you are manufacturing equipment. Right? In equipment, what happens? It goes through multiple processes and it is still in the WIP. As on 31st March, it is still in the WIP. So what is that cutoff? You can have to say what percentage of the work could have been done as on 31st March. If your system is able to give it, it is easier. Similar fashion, how do you arrive at your expected provision for bad debts? You know all the workings as on 31st March. So in next 3 or 4 days, you have that T plus 5 days where you are able to close the books. That is the only thing. It is not that you are not halting, you are not stopping any of the business. You are having a cutoff for as far as accounting is concerned. That's the only difference. Clear? So, couple of things which I'll be talking today is, one, the regulatory amendments which has happened during the past. Few areas around Companies Act, what it means, which has happened in the past, and what are all the important things which we need to be aware of. Book closure framework as to how being as a statutory auditor or as an accountant, and especially as an internal auditor, because whether you are internal auditor or whether you are a statutory auditor, there is a very important task which as a statutory auditor we need to comment. Wherever there is IFC applicable, one of the important process which we need to test is financial closure process. So what exactly we mean by financial closure is how the books are getting updated, what kind of entries are getting into the books as a monthly close or a yearly closure activity, and to what extent these adjustments are verified by the auditor in terms of the process involved. So I will be talking about that. And there are a few examples or practical observations we'll be discussing about accounting standards. Finally, the tax linkage and common errors. Why should even be bothered about whether it is year end or whether it is an audit? I don't specifically mention it is a year end thing. As an auditor or as an accountant, one of the fundamental things is how my financial statement gets audited or how my financial statement gets reviewed by the third parties. It can be multiple people. It's not just the statutory auditor whom we are talking about. There could be a due diligence which is happening. Many times it so happens we see in our own day-to-day things, we do the statutory audit, then the file gets into the next process called tax audit. The tax audit team, either in our own office or it may be in other places, they'll come up with certain questions. The general questions which they come up is, they'll say, on what basis did you say under 43B this is an allowance? On what basis did you say there is no disallowance under section 40A 1A? On what basis you took a stand that there is no disallowance of the provident fund, even though there were certain challenges in the remittance? So these kind of things which keeps coming on one hand from the income tax side. On the other hand, the GST guys, whether it is in your own office or from from the outside, they will be filing your GST annual returns. The primary question which we face is the unbilled revenue versus actual revenue. And when it comes to GST, we go by the actual invoices. When it comes to the books of account, we do unbilled revenue or advance from customers, etc. So there will be a difference. Like as an auditor, how should we be concerned, and what kind of documentation we need to have to substantiate under income tax or under GST we are compliant. Business models, there have been multiple changes every now and then. I was talking to one client yesterday. Their business is, they are the digital platform guys. They will have customers. Customers will book gold on their platform. So it's a real-time activity. I being a customer, I will book gold in their platform, and that platform will purchase gold from a wholesaler. So there are two things involved. One, when he goes and buys the stock from the wholesaler, and when he books the sales. Second, he has to comply with a concept called escrow account. There will be an administrator for this, how the payments will happen from there. Third, the specific regulations which are applicable for these entities. Like this, every now and then, or maybe fintech, the kind of regulations which are applicable for fintech. Even though I call a fintech is a technology company, there may be a chances that he will be regulated through RBI regulations, or the kind of changes which is happening in the foreign exchange. Let's say, imagine you are a manufacturer and your client is a manufacturer and he has taken a forward contract. How the way forward contract needs to be accounted? What exactly forward contract? See, basically the forward contract is one of the most complicated things which happens when we do India's accounting. I have an obligation to pay vendor, and vendor is situated outside India. I have purchased the materials and I have a 30 days credit. I will have to pay to the vendor after 30 days. At this current scenario, the way fluctuations are happening in the exchange, you would have seen USD, how the USD is increasing. You would have seen how Euro is increasing. If I do not take a forward contract, I am running a risk of me paying more money if there is a depreciation in the Indian rupees. Today, when I booked the invoice, the exchange rate was 90. After 30 days, I do not know at what rate it will be. So what these treasuries do in the company, they will book a forward contract. When I say they book a forward contract, what exactly they are doing is, they will go to the banker and they will say, I need to make a payment of say 1 lakh euros in next 29 days, which is say April 29th. Tell me what is the exchange rate you are going to give it to me if I have to make the payment. So he will say 94, if it is euro, it should be 105, 106. He will say this is the amount which you are going to pay me. So what is that which the company is doing? By fixing this forward contract, company is sure on 29th, this is the maximum amount company is going to pay. On the other hand, if there is a fluctuation, imagine the actual exchange rate goes above say 108 rupees or 109 rupees, the company is actually saving that much of variance. One. Second, the treasury is very clear how much amount he is going to pay. But the biggest challenge is, how do I account in my books? There is something called a forward premium which I need to consider. I need to restate in between. If there is a year end, I need to restate the forward at the spot rate. So these are all the things as an auditor we need to be aware of. And imagine you are liable for hedge accounting. Hedge accounting is totally a different ball game and which has to be taken care. Second thing which happens in the business model is multiple components of revenue. You may have a product which you are selling. You are also having a service component in that. You also have a warranty clause in that. If you have read India's 115, it is so clear. I need to identify the entire contract into multiple segments. I have 5-step verification over there, and I need to see that all the 5 steps are taken care. At this moment, as an auditor, we need to have the documentation to say there is a transfer of risk, there is transfer of ownership, the money there is no risk of collecting the money, and activities are done, and each of the activities has consideration, and the consideration is accordingly bifurcated in the contract. Imagine the contract is for $1 million, and it says, one, you need to sell the license. Two, the license has multiple components. Each of the components can be, say for example, I am giving a license for a logistics purpose. My customer are someone like Ola or a Uber who uses my platform, and on a monthly basis they can consume 1,000 hits, and I will say for year 12,000 hits he can use from my platform, and I agree for 1 year the fees is say $1 million, and I will have a clause. In the event, if you use more than 1,000 units, then per hit, say $10 per hit. This is one of the components. It will have another clause in the same contract. You have an option to carry forward unused. In 1 month, I used only 900 hits. I can carry forward 100 hits to the subsequent month. In the subsequent month, I can use. Third clause may come. Your liability to pay will arise only once you consume 12,000 hits. Now the question is, as a revenue, how should I account the revenue? Under Ind AS 115, there is a requirement where this is where the judgment and also the analysis will come into picture. I need to identify in the past how many times, how many hits were done, each month how many hits were done, what is the probability that he will use more than 12,000, and if at all it is sure that he is going to use more than 12,000, how should I accrue the revenue month on month? I will do an Excel and I will allocate over the period. And again, this is a very complex thing which will going to affect the way accounts is prepared and the audit has been done. Similar fashion, revenue and cost allocation in terms of transfer pricing. In transfer pricing, there is a chance. Imagine the customer, the company has marketing service, the company has R&D services, and company has, say, back office. So the way transfer pricing master service agreement look, for back office the margin could be lesser, for R&D services the margin could be higher. To make the life little more difficult, R&D may be under safe harbor and marketing will be under regular thing. In this scenario, as an accountant or as an auditor, how do we face the situation? We need to have cost centers in the books of account, identify each activity, we call it as bucketing. The challenge comes when I am able to bucket. The way we do is, how many employees are there, how many are working for sales and marketing, how many are working for R&D. That's the primary thing which we do. We allocate respective cost to respective buckets. But there will be some overhead guys, the people who are doing admin activities, the people who are doing HR related activities, the people who are into accounts. These guys have to be allocated to these buckets. On what basis do I allocate? That's again a challenge which we come across, right? Next one could be technology and controls, the kind of ERPs which they use. Recently I was doing one IFRS audit for December end, and in IFRS, one of the biggest things which we come across is how do you compute expected credit loss. So we got a report generated from the ERP. For Schedule 3 purposes, it was defined. It was about, in Schedule 3, above 30 days, above 60 days, we make the reporting, right? And we were using the similar report for computing expected credit loss. Last time when we reviewed, we went into a concept called the logic behind generating the reports. The logic actually happens to be different for Schedule 3 purposes versus expected credit loss purposes. In Schedule 3, fundamentally what we do, things which were not due, things which were due, and if it is due, from there 30 days, 60 days, 90 days. So what exactly the report which we generate for expected credit loss should be only those cases where it is due. Whereas in schedule 3 we also generate which is not due. Something which we understood, so that unless you understand the ERP better, unless you understand the logic behind generating reports from the ERP, it will be challenging for us to do the audit. Same way it could be like when you are generating the details about employee cost, or rather allocation of employee cost. And the other thing could be IT general controls. It is something which we spend lot of time when we do IFC audits or when we do internal audits. What kind of accesses the company has. One example which I can give here is the first question which I ask whenever I do IT general controls in the organization: how many of your people have got master admin, rather the fundamental rights, the admin rights, the master admin rights? Any reason why should we understand the master admin rights when we do IT general controls? Yes. How do you think a fraud can happen through master ID? Correct. Is it something easy to find out? That is, of course, that's also right thing. But what sir mentioned is something. Any idea, sir? The way it works, what you said is right. If I need to check log, unfortunately there are few ERPs. The changes done by master admin, it will not come in the log. So imagine you are checking audit trail. Audit trail is one of the fundamental things which we verify, and audit log should be saved. There are possibilities if you go and change. If you see, how many of you have done audit or accounts from the ERP? You have understood database, you understand the database in ERP. Can you just tell how it affects as an auditor or accountant at the database level? Database level. See, for example, in our audit report, we say edit log is available for the ERP, right? When we say edit log is available for the ERP, is that good enough, or should we also talk about database?
Yes, database, yes.
Yeah,
yes.
What is that we are bothered in database, or why are we even questioning database?
The access to database.
Access to database, correct.
Yes.
But what do we check there? Yes. So what can happen is, at database level, if you are making any amendments, not in all the cases, but rather in general case, it doesn't come in the trail. Very simple example. Even at tally level, the way it works, we get an output, right? Tally backup, in some way it will come. Assuming I take a tally backup and I give it to my colleague, and my colleague also has tally in their laptop, there is a chance that they will change, they will make edit at the database level, at the background level, and the third document, rather after that it goes to someone else. That fellow, whoever is got, he will not get to see the trail which shows the amendments which has happened at the database level. If it can happen at tally, it happens at a very big level at various other ERPs. So if you see, wherever audit reports are issued, my whole thing is, when you see the listed company audit reports, you will see auditors making a comment, yes, audit log exists, yes, audit log has been saved, but we are not able to comment about the audit log as far as database level is concerned. And that's the biggest concern for us when we do the audit, whether internal audit or the statutory audit. And that's where we also ask, how many of your team members have got master admin rights? And even if whoever has master admin rights, we need to be little careful on that, what kind of activities have been done at that level. So whether it is IFC or about internal audit, these are the things. And if there is a new tool which is coming, so today what they also say is, whenever we talk about audit log, we also have to comment if, say, imagine a company is using SAP as a accounting tool, accounting ERP, KEKA as a payroll tool. Even in KEKA, I need to see that there is an audit log, and that audit log is not paused anywhere in between, and that audit log is appropriately saved, rather it is available for you. Those are the comments which we need to make, and the challenge is we should know all these tools, how it works. That is where the whole challenge comes. And one question over here, you would have seen these backups needs, yeah.
How can we ensure that the data level
Data level or database level? Database level, how can you check? I don't know. I have a team at the IT level. They come and check it. They do something called IT evaluation. There are people who do IT evaluation. We send that team. They go, they verify, they take all the logs out. They take the databases out. They also see what kind of database is available, and they test. They do something called a test run. When they do the test run, the output what you get, if you do in a normal way versus if there was an editing in between, the kind of output comes out, it gives a different results. So they will give the report to us telling, look, I feel there are certain things which they have done at admin level. I am not able to comment, it is your call. And that's how we need to react.
in this case, suppose, can we rely on their IT team if they are doing a test?
Their IT team, you mean the client's IT
client's
team?
IT team.
If they are able to give you the reports, there are reports available, like how SOC2 and all those things are there, no? That because many a times we rely on payroll vendor. The company would have outsourced payroll to ADP and those guys. We rely on their SOC2 report. But SOC2 report should be dated, as on 31st March. If you see majority of this ADP and all, those guys are international guys and they do SOC for their year end, which is December or November, anything. There you need to make sure, please give it on March 31st. If you don't give, I'll have to bring this, because in IFC, I need to say, as on 31st March, it was there. That's the whole thing. Sorry, I was telling something. Backups. The requirement is there has to be backups. So the question which is there, which always my team also keeps questioning and I also keep thinking, should I take backup every day? If I take backup every day, should I have 365 backups in a year? And if you see the way these Dynamics or SAP guys charge, for backup also they charge, right? It's a big money which company has to pay. So what is that which we need to be aware of? And the answer, any answer for this? So will there be 365 backups? Then? Is that allowed under the law? So fortunately, yes, the word used is backup should be available anytime. So when I say anytime, today my backup is available. Tomorrow I'm going to replace it, but I have the backup. So why it all happened, the requirement for backup which actually came up should be, the reason is very simple. Someone would have gone to the company, like how the regulators go, they would have asked, give me the data, and our friend would have said, sorry, I don't have data, my data is with someone else. So this fellow would have got fed up and they said, boss, you need to have. Why they asked for backup is, you cannot create stories that backup is, rather the data is lost. And why they got in audit trail or audit log is to say that there are no amendments which happened. So we had challenges while what happens is, in our office we have a philosophy. When our work papers we divide amongst various other stuff, generally we'll have something called a print pack folder and a working folder. In working folder we'll have something called field work, reporting and communication, etc. The reporting and communication is the skeleton, rather I would say it's fundamental thing for my auditor report. So what we do in that reporting and communication is we save all the work papers which has a direct evidence for my auditor report. The question which came up to us last time when we had to comment on edit log or audit trail, right? How do I even go and verify that edit log exists, and in ERP the way they say, boss, I have edit log. They say, look, someone passed the entry, someone reviewed the entry, someone posted the entry, someone confirmed the entry. That I can see, and for that I should go and check in each and every transaction. Imagine I am doing an audit for a company minimum 500 crore turnover and they are working on an SAP environment. How do I even comment that edit log existed and edit log was not paused? So fundamentally what we do in our office, we have we do something called a risk assessment memo. In that risk assessment we identify what are all the risks, rather what items in my financial statement has a bigger risk. So in those things, wherever it is type A, which is high risk areas, we make sure in the samples when we do the testing, we also test edit log. So assuming I have taken 10 revenue invoices which is high risk, for all those 10 invoices it is mandatory that we verify edit log, that edit log existed and it was not paused in between. So this way I have a better evidence to substantiate whenever I am signing the financial statement, and this data goes and sits in my reporting and communication folder as part of my edit log workings. So another thing again, systems under pressure at year end. Definitely we have seen this. Multiple transactions are happening. Multiple tools are getting used. Imagine a scenario where I work on an ERP environment and I also use Coupa, right? Coupa is one of the major tools which company use for doing purchases. So whichever purchase order which has to happen, it flows through Coupa. From Coupa it gets approved and there will be a plugin to move the entry to SAP or Oracle, as that the case. When at the year end it is bound that I need to close all my open purchase orders, I need to close all my GRNs, I need to close all the security checks. Imagine the kind of pressure which would be there on the tool. So you need to make sure that the tool was running fine and the transactions were going decent and my books of account is appropriately updated. Last one, very important, which we spent, how many manual journal entries are getting passed. This is the fundamental thing. List out all manual JVs, which is of course little challenging. In terms of ERP environment, we are able to generate the reports. Again, you need to define how to generate the reports. In ERP, the biggest challenge is, I keep telling people, whenever you generate report, please don't presume that the report is true and correct. It all depends on the logic behind what was written for generating a report. A report which is generated, the PO report which is generated for budget could be different from the PO report which is generated for GRN. There is a concept called service receipt note. GRN is a goods receipt note is a standard thing. Service receipt note, meaning assuming I am providing audit services to my client and that client has to close once I complete my audit, he has to close the PO using a service receipt note. So to what extent service receipt notes are created? If my GRN is not considering the service receipt note, then the report what I generate will not be complete. So we need to be aware how the reports are generated and generate the AJV reports completely, run through the AJV report and make sure that all the entries which are passed are proper. So the challenges which I have seen in journal entries, fundamentally the foreign fluctuation. SAP will pass one entry, it will take the rate as fed by the group entity or as fed by my treasury guy, but actual entry it will be different. That's a AJV which hits very badly. Second, the AJV could be on ESOP, right? So ESOP is again item on its own, but one thing I want to share it here. Let us take a scenario. I am subsidiary or an associate of a global entity and I am a pretty small guy in terms of my capacity in India. I have around 20-30 employees working for India. I am a 100% captive entity. I provide services only to my parent through transfer pricing. I provide service, I invoice through transfer pricing. And my parent or some related company in the group is listed. It is outside India. And that entity gives stock option to my employees. Right? It has given stock option to my employees, but it has not cross-charged stock option, the value of the stock, rather the cost of the stock option to my employees. Understood? What is my obligation when I close my books of account? As on 31st March, I need to close my books of account. Mind it, I am a transfer pricing company. I need to do cost plus billing. My employees I have not given any ESOP to my employees. ESOP is given by one of the associates. It can either be my parent or it can be any fellow subsidiaries. Is there any obligations on Indian entity as far as accounting is concerned? And they are not cross-charging.
And these employees are on your payroll.
They are in my payroll.
Then you should accrue it.
How do I accrue? They have not cross-charged to me. Whom do I pay?
Manually? No.
No, okay. In your case, accrual means I'll debit expense. I'll debit employee benefit expense. What do I credit?
The intercompany?
He has not raised invoice, no?
Yeah.
Anyone?
Provision liability for payment, then at some point you will have to pay to the employee.
He will never, my parent will never raise an invoice.
No, not the parent, but ultimately it's an expense in the Indian books that has to be paid to the employee, no?
No, sir. How it happens in ESOP is, one of my associates, they gave stock option to my employees, and when it is vested, either after he exercises, he is allowed to sell whenever he wants. He will just, what my parent does is, they will open one account in, maybe there are hundreds of guys who provide these services. They will pump all the stocks into that particular account. Employees will be given user ID. It is like Demat account. That stock will come and sit in your Demat. You can sell whenever you want. Nowhere Indian company is involved. Yes, sir. No recharge from parent. How? Capital, what entry you pass?
You will debit the ESOP expenses in the Indian books as per the Ind AS frameworks and credit the other equity head.
If it is not Ind AS?
If it is not Ind AS, there are certain guidelines which needs to be specifically followed as per the terms and conditions of the agreement.
That means if the agreement says no, I will not cross-charge, I will not even account.
You will not even account in the non-Ind AS scenario.
Okay. Why do you feel in Ind AS it tells that? What is the objective, rather the logic behind that Ind AS?
The logic behind that is there, eventually an Indian company employee has rendered a services which benefits the organization outside India, and the true character of the transaction is to account for it in the Indian books as well, irrespective of the recharge agreement in place or not.
Superb. Under which concept this comes into picture?
Share-based payments.
No, that is different. What is the fundamental concept? Share-based payment is what expenditure is booked.
Correct.
Otherwise, what is the fundamental concept?
Matching concept. Basically.
Fair value.
Fair value.
Rather, fair value. So thanks a lot for this. So, and you said you will credit to? Other equity. In other equity, how do you? Share-based compensation.
Terminology what everybody.
You will show it as share-based. And how do you close that share-based compensation in the balance sheet?
So that is a very good question which we also have been dealing with clients. Generally, if there is a no recharge, this reserve gets accumulated in your books and your net worth keeps on increasing year on year.
And when you liquidate?
This is a question which we had raised, especially from a Companies Act perspective. Is this a free reserve available?
As per Companies Act, no.
No. Correct. Though that has been a very debated topic in terms of the discussion. And the other crux to this matter was what will happen to the share exchange fluctuation that happens.
Pardon me?
What will happen to the share exchange fluctuations?
Okay.
If in, let's say 5 years down the line, they agree that we will do a recharge.
No. When they do a recharge, it's a different ballgame. It becomes a contractual liability as
Contractual
far as
liability as on
109
that
or various
particular
other
thing.
things are concerned.
Correct.
But yes, thanks a lot for this. See, this is the concept under Ind AS. What they said in Ind AS is there is no way this employee would have worked. And fine, when I use the word captive entity, right? The Indian entity is working for sole purposes of the parent. And whatever parent is doing for my employees, he wouldn't have done if this employee was not my employee. And he is doing it just because I am part of the group, so I am obligated. When I say I, the company is obligated to account it as an expenditure and give a credit to something called other equity. In Ind AS, it was very clear. And guidance note has come, sir. Under AS also you should follow the same. It's a simple thing, you have to follow the same. The whole reason here is when you do, assuming you don't do, then what is the implication? Because you say there is no cross charge and you are not even following Ind AS, where Ind AS it is mandatory per se. If you do not do, what could be the impact? Is there any regulatory impact? Yeah. No, other than Ind AS. What is guidance note is for auditor, not for the company, right? So what is the impact? What is the regulatory impact? Pardon me?
Books are not true and correct.
Okay. The way it is happening is transfer pricing issue. Because I said I'm a cost plus company, the TPO can consider this expenditure as your you should have considered. Had you considered, you should have added your margin. Had you added your margin, there would have been a profit for you, and on profit you should have paid taxes to me. So the TPO are sending these notices, and there is a risk for you. Even though you are not recognized revenue, you will end up paying a income tax. So you need to be careful. So it's better to follow what is possible. And second, assuming I am in AS, I have never accounted this in my books. Is there a way? How will TPO get to know? Is there any other way in which TPO is getting to know this? DMAT happens at global level, not in India. You are there somewhere, but you need to give a different, a little better answer. That they sell outside India, because it's a foreign asset. Under FEMA/RBI, you are required to do something called OPI filing. Under OPI filing, you need to tell how many of your employees have ESOPs of the group, what was the opening stock, what is the new vesting during the year, what is the closing. So when you are disclosing this, you are obligated. Employer is obligated to disclose. When the employer discloses, the data is getting circulated everywhere, and somewhere department will get to know, and through that there is a chance that they will send notices. One. Second, last year, majority of these guys got notice because for you to do this transaction, you need to have a foreign bank account. The moment you have a foreign bank account, but you have not disclosed, when I say you, I mean individual, the employee. If he has not disclosed, then department send notice telling foreign assets are not disclosed and you need to pay taxes. So it's a multiple pool through which the data can circulate, and better to be aware, keep your employer or your client informed about the possible impact in case if the accounting is not done. So what we used to do until last 2 years, my institute had given a guidance, if there is no cross recharge, you don't have to account. But 2 years back it got amended. Now it is in line with the Ind AS.
Sorry, just to add one
Yeah.
more. So there are a couple of practical challenges, especially when we follow non-Ind AS scenarios. One of the differences, the accounting year difference.
Accounting year difference, yes.
When you follow share-based payment accounting, you rely on certain reports in terms of share valuation reports.
Agree.
And that happens at a global level, considering their global attrition rates
Agree.
and not what is specific to the Indian entity.
Agree.
And the beta mechanism or the butterfly spread what and all
Agree.
they use. So that actually becomes very procedural difficulty, and getting such type of reports for only India specific valuation is not at all a feasible scenario for the clients.
But the solution there is very clear. Even the standards which they use for their reporting, it is in line with our Monte Carlo. I think they use Black-Scholes. And they also go by graded vesting. So if you are following graded vesting and if it is as per the Black-Scholes, you are good. You have a window of 6 months. In the 6 months, if there is no major change which happened in your company, imagine the last valuation was done in, say, September, and you are closing it for the March. Between September and March, you have not sold your stake, your products is not sold, rather IP is not sold, or no major customers are lost, or no major new customers have come. If the delta is not so much, whatever the assumptions you have used for your global purposes holds good, and it is fine, no matter whether under, even MB has approved this. We have got the approval from MBs also. That way it is, you can take it. And even the investors agree for that. Few other things. The regulatory intensity is one. Peer review. Now peer review is mandatory for quite a few entities. Something which I learned through the peer review which happened in my office. We do sign couple of listed companies, and by practice we try to see that our documentation is strong. We shared all the data to the gentleman who had come, who was a very nice guy. We had shared all the data. He asked one very simple question. We use an audit tool, so all our work papers are stored on the audit tool. He had a checklist telling, Vikram, show, do you have engagement letter? Tick. You have MRL? Tick. You have financial statement? Tick. You didn't generate everything. So it came to something called an audit plan. Then my team showed him the audit plan. He saw everything. Then he said, where is audit procedures? I said, audit procedures are there in the work papers. But something which he told, Vikram, I agree, you have an audit plan, you have audit procedures, but how do I connect things? So after he telling, what we have brought in our office is, we make an audit plan, just extend it by 3 more columns, see what is the audit procedures you are gonna do. And that audit procedures will be in line with what is the audit work paper talks about. So by doing this, which actually made my life little easier, at the audit plan level, my managers will be able to see what are the challenges in each of the activities. They'll be able to edit the audit procedures, and whenever there is audit plan, they can also go and tell, there is one column in the audit plan, is the work paper complete? So they will go and mention in the audit plan, is work paper complete? It is just maybe 1 or 2 minutes additional for each line item, but makes the life so easier. I need not to, there are possibilities that I would have said revenue, it happens in cost plus companies. We'll say revenue, I will always do revenue at the last moment, because expenses should be closed, liabilities should be closed, then only the revenue will come. But we may end up, because of that pressure which comes at the end, we may miss updating the revenue work paper. And nowhere in the tracker it comes. Because revenue work paper, the simple way we do is, go to the P&L, see the cost, multiply by 1.15 or whatever it is, the revenue matches, it's closed. So we may not even, many times there never used to be an audit work paper. So thanks to this gentleman who came for peer review, he advised, and we have changed those. And I tell you, peer review is actually one of the good things to get it done as far as audit firm is concerned. It exposes quite a few loopholes which we may have in our own systems, and that way it can be improved. Due diligence, I keep seeing in my clients, some due diligence happens, some question will come on us. The fundamental questions which comes in our case, rather which I have seen, is one, the intangible asset. Majority of the companies will show their intangible assets in the books. They will say hundreds of things and it is there. Unless my work paper is strong enough, I will not be able to substantiate. In one of the slides, I will talk about that. Finally, also, one challenge which I had faced, it was a peculiar challenge. We have a client where there was a family settlement, and this company was pretty big and family settlement happened. There was a sharing of assets amongst the family. The first question which will come by whoever is not happy with the family settlement is audit is not done properly. The whole records what they will say, no, I got very less, my valuation was less, the books of account were not properly audited, auditor is a culprit. So that's the kind of questions which comes, and that's where as auditors we need to be careful that we have enough data and we have enough documentation with us. Regulatory intensity is Caro 2020. First 2-3 years Caro was little soft, and now things have gone to a very rather the complexities have been taken care. The procedures have been very clear. There could be quite a few questions on those. And I think, okay, amendments effective 2026. There are few amendments which each one of us should be aware of. Whoever follows Ind AS, there is a small change in current versus non-current. So what used to happen, the simple definition was in non-current is anything where I can defer the payment beyond operating cycle / 12 months, right? The question which always used to come to our mind is, I have a loan obligation, there is a loan covenant, and if the loan covenant is affected, meaning I failed in one of the covenants and the liability becomes current. How should I treat at that scenario? So what these bankers do, there is a covenant which is failed, the customer will go to the banker, he will get an additional confirmation from them telling extending the liability. So previously that extension of liability, I was not in a position as per the Ind AS to shift it from current to the non-current. Now with the amendment in the Ind AS, it clearly tells it is not just the documentation, you should also see the intention. So how the intention works, and also the covenants which is failed, assuming as on 31st March, I have a document to say I can pay after 12 months. If that is there, I can push it to more than 12 months. There are two other amendments which has happened in Ind AS. Another one is on foreign exchange, which is too complex and not much used. The third one which I was worried about, whoever is working on multinational companies, BEPS 2 was a bigger impact. Example, in India we have 22% plus 3% as tax rate, so it comes to around 25%. So at OECD level what they have said is, across the tax rate, minimum tax rate should be 15%. That's one of the BEPS 2 proposition which is done. Imagine I am a group, I have a subsidiary, and one of the group entities, there the tax rate is below 15%. If the tax rate is below 15%, as per BEPS 2, I need to create a deferred tax to the delta. Assuming their tax rate is 10 and I need to top up it to 15%, and I am consolidating the books. I had a very big challenge doing this top up, rather grossing up of 15%. Thanks to MCA, they have got in an amendment. They said at this moment for this adjustment is not required. So that way we have been saved. Next, Companies Act amendment, small company definition is amended. The 4 crore and 10 crore definition, whatever was there, now it is 10 crore and 100 crores. The turnover up to 100 crores and the capital up to 10 crores. What is the biggest advantage and what is the biggest disadvantage also? So as the thing is, Caro, you need to see the applicability of Caro as per the requirements of the section. For a small company, Caro is not applicable unless the small company is neither a holding or a subsidiary and those stuff. Now you can see two things. Whoever were liable for last time Caro, they may not be liable now. And also you should see whoever was not liable, they may become liable. Keep an eye on this. Next, the POSH, the prevention of sexual harassment. There was a requirement to disclose the complaints which were raised in the POSH through the annual return to the competent authority. How many of you guys have seen this report? Yes, sir.
Sorry, just regarding the previous thing about the small company, you said there's advantage. What is the disadvantage?
as an auditor, Caro is not there. You are pricing. So how many of you have seen the POSH reporting? You have seen. So through the corporate return or through the competent authority return? Competent authority, okay. Now it is, very few know how it has to get communicated. Now it is mandatory that it has to be part. The director's report will have these details. Essentially, how many complaints had come, how many complaints are resolved, how many complaints took resolution of more than 90 days. So that has to be disclosed. Any exemption for this? Any exemption for not complying with POSH? No exemptions. Whether you are a company, branch, head office, proprietorship, partnership, it is liable. You need to only change could be the having that IC or EC may be different, but compliance is required. Maternity disclosure again has to come in the report. How many, that's 56 weeks of leave or something is there, that many leaves has to be given, and the compliances of that has to be disclosed. So now what exactly the auditor's reality at the year end or the company's reality? One, majority of the adjustments variably or invariably happens during March. It can be revenue booking, it can be customer collection, it can be at times the biggest challenge which I have faced is accruing commission. I need to accrue commission. The accrual of commission happens based on the annual activity, followed by the collection of revenue by individuals. So those kind of adjustments. Adjustments may be because of provision for bad debts, adjustment of gratuity. Now the biggest challenge which I have, how much gratuity should be accounted. The way it works, end of the day, SA 315, SA 330, which is risk assessment and risk responses to the risk assessed, it has to be appropriately documented. And the NAFRA has issued one important series interaction. The committee has issued one note. The whole thing which they have spoken about is intangible assets and impairment testing of the intangible asset. Whoever is doing the listed company related activities, be careful. There is a specific note issued by NAFRA how intangible asset is amortized or impairment testing done. There is an additional requirement over there. Finally, the managements expect a kind of clean report. Auditors should make sure that they have the respective evidence and the closure should be in a proper way. And about amendments, I spoke about, one amendment which has happened is whoever used to file XBRL previously, even I used to find it difficult. If I download an XBRL document, it was challenging for me to understand how a financial looks because it was a separate format. Now thankfully there is a requirement to attach the signed financial. So you need to, along with the XBRL document, you should attach the signed financial. That is an amendment. Second, with all these annual returns, whatever you are doing, there is a e-form which gets updated. We have seen lot of cases. You will have financial statement in Excel. You have return done through a different format. At times the numbers used to be different. What I sign in the financial, what gets updated used to be different. Now thanks to this, I feel the difference, such kind of errors will not happen. Other regulatory thing, audit trail, which has become a routine now. For high value transaction, try to make sure that either as an accountant or as an auditor, for all the high value transaction or risky transaction, the audit trails are checked. It is saved appropriately so that tomorrow whenever there is a query, you will be able to disclose those. It is both for auditor and accountant. Schedule 3, no changes in Schedule 3 as things stands today. It remains the same. There were amendments which has happened in 2-3 years back. Importance again, the few notices which I have seen is more about how the AR/AP aging has happened. Compliance with CSR. Whom did you spend the money, and where you spent, is it legally? I mean, it has happened in a proper way and it is in compliance. Those kind of notices which are coming. Rule 11E, fund flow. I'll spend some time on this. This is again an amendment which has happened wide through the auditor report. There is a specific requirement to comment I being a company have not received any money from anybody else to lend money to the third party. One. Second, I have not used my security premium or my borrowings to lend money to any any middleman to give it to the ultimate beneficiary, which is a little long process, which a sense the whole logic here is money, there is a trail for the money which is moving. I cannot lend money to Mr. A telling him please lend it to Mr. B. That I cannot do. So the way it has to be done, please keep a track of all the transactions. Couple of notices have been issued through related party transactions where the money would have gone to related parties and from there it would have gone to others. That trailing has to be properly checked. Look at the documentation and you will be able to close. Caro 2020, no changes. That's it. Few things, Ind AS 1 I discussed, Pillar 2 I discussed. Okay, one amendment in Ind AS 7 or Ind AS 107. Whoever is in, say, I would say manufacturing companies which generally use, I buy a machinery and this machinery is bought against an extended credit by the seller, which means I had to pay him say $500K dollars. He tells you take the machine, I will also allow you a credit which you can pay over a period. Majority of the manufacturers have this facility because they will have a corresponding NBFC with them and they give this facility. The challenge we used to face, rather everyone used to face, is it a trade payable or is it a loan liability? In our office, we had taken a stand, it is a loan liability, and thankfully now Ind AS also got amended. All these supplier credits should be treated as a loan liability. One. Second, you should also disclose what is the opening balance and what is the closing balance. You should also disclose the sensitivity analysis. In Ind AS, sensitivity analysis is one of the most complex things which I have seen. So just to tell how sensitivity analysis look, why I find it difficult. Imagine I have a liability in foreign exchange. I need to give a sensitivity for every dollar change. What is the impact on my books? For every receivable change, what is the impact on my books? For every hedge fluctuation, what is the impact on my books? I need to disclose those, and that disclosure is also required for supplier credit also now, right? Yes, sure. Yeah. So we'll take a break and we'll continue with the book closure process. So, yeah, welcome back. Few things which from now I'll try to go a little faster. It will be more on the processes which either as an auditor, as an accountant, which we need to follow. The way I have tried bringing here, it's a kind of process which I tried bringing here. It could be pre-closure process, the closure process, and post-closure process. That's how it goes. Left to right, it moves the same way. In pre-closure, the first and foremost thing is the ledger scrutiny which happens. Even at a statutory audit level, whenever we do the IFC for financial closure, we are required to see how this activity works. And the next one could be open items review. Fundamentally, what I mean by open items review is, what are the open POs? Why should I be bothered about open PO? Any idea? Is it contingent liability? Yes, it is accruals. So how does it work? If you can just explain a bit.
I have the company does whatever is outstanding in the PO balance, which is not paid to them. They say that they approve this in their books as a liability because these are the areas
where they expect expect a bill to come for the services or the goods that have been rendered.
Correct. That is, so there the catch is services or goods should have come. Now, if the services or goods which has come, why PO is still open?
Yeah.
That's where the question comes.
Yeah.
So, what exactly can happen? If I have to give an example, imagine you are extending a facility, rather fixed assets, and the way it tells is you have done fixed assets and the payment will happen over a period of time, and assets have been there. There is a retention money. Say 20% is a retention money, and for the 20% invoice will not come because the invoice will come only after the retention period. The retention period could be 8 months or 12 months or etc. Unless you go and check the open PO, there is no way you can find out that what is the actual value of asset. The actual value of asset may be say 1 million, but you would have paid only 80% of that. Balance 20 is never capitalized. You cannot wait until an invoice comes. You should capitalize it now because 1, the asset has come to your control. 2, the assets, you are using those assets and depreciation has to happen. So your depreciation should be on 100% and not on the 80%. And tomorrow after you receiving that balance 20% invoice, if you capitalize, you have a challenge. Both under Income Tax Act and under Companies Act, vis-a-vis either AS 10 or Ind AS 16, you have an issue. In the whole concept, do you see any challenge from other regulation? Superb. Yes, that is one. Then it's a disclosure. Then there is one major issue in this. I told I'll pay after 1 month, 1 year. Any issue here?
So,
MSME is one. Yes.
financial liabilities which are long term needs to be discounted.
No, here it will be a fair value. If I have to pay him after 1 year, definitely would have considered the interest component in that. When the costing happens, he has considered the interest component and is total that. There is one more. If a payment has not happened within 6 months, I should reverse the input credit. Right? If I have considered the input credit, I should reverse the input, and I should make sure that to that extent, if at all the reversal leads to any liability, I should also pay interest. So that's one concern which you need to be aware of, and if at all it is going to impact, that could be a bigger impact. And as sir mentioned, it is about the capital commitment which I owe, that has to be taken care. Cut-off planning I explained. Department coordination is another important thing which is very vital for anybody to keep in mind. So example could be, imagine in today's scenario, the accountant should have the information about the legal implications of the gratuity from the HR team or a legal team. The revenue team should have the confirmation that the contract has been accepted by the customer and there were no challenges as far as liquidated damages are concerned. So the way it works is, under Ind AS 115 or even under AS 9, if there is a liquidated damage, I am a seller of a product and I had to sell the product, or rather the product had to be accepted by the customer within say 90 days. If the date, if the delivery has happened after 90 days, there is a possibility that they will levy liquidated damages on me. And as an accountant, the accountant will not know. He has to get this confirmation from the delivery team or the client, rather customer management team. This coordination is something again which is pretty vital. And third one, which I see in big companies, you will have multiple divisions. This is also a challenge which I face when I do multinational companies where there are multiple divisions. It's in one, if I have to give an example, in one of my clients, it so happens that the GST team sits outside India. Why they sit outside India? Because they are the ones who run the revenue and they manage also GST. And what they have done is, this team is sitting outside India. They have a consultant who sits in Kolkata and the client is in Bangalore. the GST reconciliation from the data which flows in different ways, nobody knows what is happening. The accountant will never know what is happening. So as an auditor, I need to talk to this Kolkata guy, then I need to speak to the person who is there outside India, consolidate, and then only I'll get to know whether the returns are filed in time. If at all it is filed, how is it filed? For example, whether they have considered SCM on imports, whether they have considered the GST which should have been reversed, etc. That's a bigger challenge. So there should be a kind of coordination amongst everyone over there. Reconciliations, few things, bank reconciliation, which is of course people do. AR/AP aging as per the requirement of Schedule 3. Keep the tracker. Your AR/AP should be so strong that any point in time you have dues which are either due or not due. If it is due, what is the aging involved in that? GST are 2B2 books, what is my book showing versus what is GST returns are showing. That's again both on the revenue part and on the input part, it has to be reconciled. And fundamentally, as I explained before, unbilled revenue, and those are the fundamental differences which can be there. RPT mapping, the related parties transaction mapping, which has to be done. I don't think I need to explain. Okay, one thing which where both as auditors and as accountants, sometimes the challenge which will come is how do you get to know that a particular employee is not a related party or a rather relative of a related party. So we faced one issue in one of the companies. A senior person's wife was appointed, and that person was being paid salaries. Fundamentally, by definition, relative of a key managerial personnel should come in the related party disclosure, and unfortunately it was missed out. So the way we started, we learned from that. The subsequent times we made it very clear, when we start the audit, we make sure that we take a list of related parties from the legal team or from the secretarial team. If either of these two are not there, take a confirmation from whoever is the founder or a promoter, keep that list, ask certain questions to say are there any new people who have joined, try to keep wherever the payment are little higher or more, see to that whether that person is a related party or not, and accordingly update the same. ECL computation, impairment testing, both are very, very vital. Impairment testing, especially on Ind AS, where the intangible asset is capital in progress, impairment testing is mandatory, and assets which are already capitalized, unless you get an evidence, you may ignore doing impairment testing. But this is a complex scenario. Many of the times I have found it very challenging to do impairment testing, because even for you to capitalize an intangible asset, it is a concern. Rather, you will not have the evidence to say that asset is actually giving you the monetary benefit. Imagine a startup which is still in the process of building a product, who do not have much of the customers, they have customers in pipeline, or rather they have customers, they will know there is a proof of concept. The proof of concept is based on, I'll give an example. There is Google who gives the Google Maps. There are so many other applications which also gives the maps. And in logistic companies, they try to bring their own product for maps. They say if I need to pay to Google, it's a very big money which I need to pay. Instead, I will develop my own application which helps me to manage the logistics. Now the question is, first of all, will you be succeeding in completing this application? Second, if you succeed, what is the quantum of benefit which you are going to get? And if you are able to get this quantification, how efficient you are in terms of technology to say that you will sustain over a period. And fourth, which is also very important, if you are a platform company and if you have given it to your customers, even the customers should accept this product. They may be trusting the Google and they may not agree for this. So multiple things will come into picture. So even capitalizing could be a challenge. Once capitalized, impairment is another challenge. Litigation review, while reading litigation review, I got something in my mind. There will be something called guarantee in the books of account, right? And how do we disclose guarantee in the books of account? contingent liability. So once I disclose contingent liabilities, as a company, are there any other obligations to comply with? So the first thing will come into picture, whoever has done Ind AS, the first question is guarantee accounting done? Right? So what I mean by guarantee accounting is, generally guarantee will be given by a associate enterprise. So imagine I am a subsidiary, I want to go for a loan, I will not have any security with me, I will request my associate to give a guarantee. It's a financial guarantee, not a performance guarantee. They'll give me a financial guarantee. Under Ind AS, I need to do an accounting called guarantee accounting. Fundamentally what I do, I will debit finance cost and I will give credit to other equity. So I am bringing this like how we discussed about ESOP. The similar entry will come in my books of account. What is the second possible compliance issue? FEMA, okay, you mean to say ODI? Rather, it is more of I received a guarantee. It is better. If I give a guarantee, then ODI will come into picture. I need to make sure the guarantee, including investment, is not more than 400% of my net worth. But there it is easier because even to give a guarantee, banker has to give. Banker will not agree unless you disclose the ODI, the statement. Another issue is GST. There is a provision which speaks about GST on the guarantee that you need to be aware of. Audit trail. So audit readiness is basically keep the PBC checklist. When I say PBC, what I mean is the provided by client. So what we generally do, we share our document requirement list or the documents which we request from the client. We share it with the client. For him, it is the fundamental document on which he updates. For example, if it is revenue, I'll ask him the revenue listing. I'll ask him the last 5 transactions and first 5 transactions. I'll ask him the agreement, etc. So he has to share it with us. So as an accountant, what I have seen the best practice in the company is when they close the books, they also make sure that their PBC is updated so that they need not to go and again update when there is a audit which is happening. In our quarterly reviews, whenever we do listed company audits, they will keep our PBC well updated. So we also do audits for a couple of family offices. The kind of philosophy what we have got there is, you know that we need to update clause 34 of 3CD in every year, and clause 34 is one of the most complex things. Both clause 34 and clause 44 in tax audit report. Clause 44 is GST reconciliation, where you need to mention how much of the materials are purchased from unregistered dealer, how much is under reverse charge mechanism, everything we need to disclose. What we recommend our clients who are fundamentally family offices is maintain this database on a month-on-month basis. Whenever you do your monthly TDS workings, do it in line with clause 34. Whenever you do your GST workings, do it in line with clause 44, so that you have to just consolidate the numbers and year end you have the data available with you. We used to see lot of companies giving a comment in 3CA telling clause 44 is not available because the database is not there. Finally, we started getting couple of notices, then people have realized and they have understood, and also clause 34 has issued lot of notices. Error in clause 34, which I feel very sad. There was an issue in terms of section 195, 916 and 917. It was a disclosure made by one of the consultants while they did the audit, and that issue resulted in a bigger impact on the company because 195 was a 20% issue. So they had to deduct at 20%. The quantum of fund becomes so huge that company had literally had to go through 3-4 years to recover from that. So instead, if these compliances are done well in time, and it is, I keep telling the companies, wherever there is a doubt, deduct taxes at a higher end, because at your end you are not missing out, and for the other person he may anyway get the credit. And this will not lead to any possible non-compliance either under section 201 or any other section per se. Covenant certificate, this year I am asking you guys to be aware of covenant certificate because of change in the current and non-current disclosure. Keep the documentation available. Management representation is of course the final one. What exactly we need to be worried? One, trial balance. Look for all negative balances in the trial balance. Many times negative balances appear because of wrong disclosure. There could be a possibility that you have given an advance to one of the vendors and that advance is not adjusted against a liability. You have created and you have made one advance and there is an invoice which is raised by that particular vendor. Invoice is showed as a payable and advance is shown under asset. So it results in negative thing. Similar way it can happen in customer advances. Similar way it can also happen in employee advances. So all these negative items you need to be aware of. There are quite a few tools available in the market. You can actually run those tools with your accounting ERP or accounting software. It will identify the transactions which has negative balance. It will also identify transaction where there are no transactions during the year. It will also identify transactions where entries are passed directly into the GL without passing it through the vendor vendor account. So multiple tools are available. This will actually help reducing our work. So in our office we use certain tools and trust me, the kind of savings what we are doing, it's tremendous. Just one report, I'll get some 15-20 important reports including the kind of depreciation working they would have done. And this 2 or 3 of my people would have taken 3-4 days to do this. It will happen in just a click of button. Second thing which I would like to share it here. All of us, we prepare the statutory compliance matrices. We make Excel sheet as per books of account how much PF was deducted, as per challan how much PF is remitted, when was it remitted as per the PF challan, and as per the books what is the date, and is there any delta in terms of amount. So fundamentally how we do this all comes to us through PDF document. We should open a PDF document. Copying is many times challenging. Key in, copy there and key in on my Excel sheet, and there could be errors which happens at Excel sheet level. Instead of accounting it, instead of writing as 1095, if I do 1905, again there is a difference. So and if I need to go and rectify, again I need to spend double time. Whoever is doing, they have to do double time, and this takes, even if a small company, definitely 3 tedious payments will be there. Definitely 2 PF challans will be there. You will have 1 PT like that. To do this, it will take good number of time. So what we have done in our office is, we have written a Python, and the way it works, it works really well. This Python formula, Python how we have created is, it works within my server. It will not go to anywhere outside. And PDF, all the PDF documents are within my server. I have defined the Excel, the format how it has to come. Just one click of button through the command. Once I run the command, within a fraction of couple of seconds, it will read all the PDFs. It will create an Excel sheet. It will also tell as per your books how much is the PF, as per challan how much is the PF, if there is any delta. So imagine where I used to spend 3 days to do this. Within a command which is just 5 seconds or 10 seconds activity, it is able to give me the report, and I can concentrate only on where there is a difference. If as per 194J in the books it is 10 lakh, as per challan it is 10 lakh and 50,000, I should be bothered only about that 50,000. I don't have to look up other activities which has happened. With all these products which is available, one, effectiveness is improving, two, the dependence on individuals is also reducing. I request each one of you spend some time on understanding how a Python could run, understanding how various tools which you can use to generate reports to reduce your work. Dormant accounts, again we have to spend time on dormant accounts, because under schedule 3 we need to report are there any stuck off companies. You have any transaction with the stuck off companies, that will help. Ledgers versus subledger, again in ERP environment I find it pretty challenging. the way ERP works, there will be one ledger called prepaid expense. So they will show prepaid expense 68 lakh rupees. The details of prepaid expense will be available either in an Excel sheet or in a reconciliation tool. There will be one reconciliation tool where they mention 68 lakh breakup is ABCD. Insurance is 20 lakh, some rates and taxes 10 lakh, etc. These two should get reconciled. And many times this Excel sheet will not get updated. The opening balance still continues even though there is a prepaid expense which is allocated. Since it is Excel sheet, it will not get allocated on the books of account. So lots of issues we face in the ERP environment, and this testing is something which is pretty important. It also happens in, imagine you have a separate FA module. You are using one accounting tool where it does not have a FA module. For FA purposes, imagine you are using FAMS. So FAMS will have all the details about location and the nature of asset. It will run the show. It will keep all the data. From there, the entry should move to my ERP. There also we need to be little careful. Revenue cutoff, I think I explained on this. Expense accrual, performance bonus. Performance bonus is something as an accountant and as an auditor, we have to be careful. The first and foremost error which I have seen, this performance bonus disallowed under section 43B at the tax audit level. Please note, performance bonus need not to be disallowed under 43B, because under 43B what has to be disallowed is the statutory bonus. This is more of an incentive. It is more of part of employer-employee contract, and it is there on the, it is just like a salary, it has come over there, and you can take a call. You need to understand how the performance bonus works, and there is a possibility that it need not to be disallowed under 43B. 41A is a different ball game, but at least under 43B it can be avoided. Similar way, commission payable, I keep questioning here. Commission payable will arise, the way the contract looks, imagine you have a marketing team and you need to pay commission to them. The way it tells is the commission will be paid only upon actual receipt of money from the customers. So your accrual also should have these kind of elements while you do the workings. Just because there is a sale, it's not required that you need to accrue the entire amount. You need to accrue amount based on how much is going to be converted into the cash. Post year end invoices, a standard one, April 1, April 2 invoices should not fall into the current year. Gratuity I explained. Ind AS impairment I explained. Litigation provision, many a times the question will come. As an auditor we tell the litigation, it has to be accrued as a liability in the books. The management may argue telling it is not a liability which has to be there on the books. One thing which we see, can you get a legal confirmation from the expert to say why should there not be any liability which has to be accounted in the books.
Just a second, let's check the
Probability, right? Probability of these. So for that you ask legal team to confirm?
Yes, for
Okay.
that only we ask, because if I need to take a example, say you have filed for a refund in the last 3 years and you are showing in your books GST refund, and in one of the refund applications the officer identifies that the way you have computed your expenses, rather input versus the export, there is an error. Imagine you have been considering refund for one activity which department tells it is intermediary services. So the moment it is an intermediary service, you are not eligible for a refund, and you have got an order. Other 2 years are still pending. Now the question arises, should that refund which is shown as an asset should be moved to expenditure? Because you have an evidence, you also have a probability that this will convert into an expense until last year. Now anyway, amendment happened through intermediary, but just an example. Like that, if you have an evidence to showcase that there is a probability that this will go against you, then definitely you need a thing. Or maybe a scenario where the entity is showing income tax refund for a very long time. and what is the event which is happening, what kind of activity, what kind of assessments are happening, and how you are demonstrating the thing. We depend on the legal guys, or rather whoever the consultant, for them to substantiate. Forex adjustment, again, this is one thing where I see lot of errors in the accounts. We do foreign exchange fluctuation accounting, right? Assuming I have purchased an item from outside India and I need to pay him in a foreign currency. Let us take an example. I am a captive entity. My only customer is parent, and I raise an invoice on my parent. There are two components. I had to expand my facility, so I have taken advance from the parent, one. Then I also have an invoice to the parent telling for a particular month I have raised an invoice. So there is one advance from the parent which will be adjusted against future invoices. There is one receivable. Can I treat both in the similar way, or should it be separately, it should be accounted in a different way? Both have an impact on foreign exchange. If advance has come, against that advance I raise an invoice. If receivable is there, I would have raised an invoice at 90 rupees a dollar, and as on 31st March it has become 92 rupees. So 2 rupees is the delta. The another thing is, customer has paid me advance at 90 rupees. Today if I have to raise an invoice, it will be 92 rupees. In this case, is treatment one and the same, or are they different? Should I restate both? On one hand, I will show foreign fluctuation loss of 2 rupees. On the other hand, I will show foreign fluctuation gain of 2 rupees. And can I net it off?
They have the offsetting argument where they say that however,
advance is for sale of product, receivable is for sale of services. Then
Agree to this. However, FEMA doesn't permit such type of activities, and practically it is not permitted.
correct. Now, can I then, that means to say for advance I will restate, for receivable I restate. Fundamentally 2 rupee loss and 2 rupee gain. P&L no impact. Is that the thing? Sure. Are we missing out something there?
Nothing else.
Is advance from a customer,
Non-monetary.
advance from a customer is a non-monetary item. I am not supposed to restate advance from customer, because assuming my agreement is to sell a product for $100,000, he has already paid me $100,000 at 90 rupees, but when I raise an invoice, it becomes 92 rupees. I cannot raise an invoice for 2 rupees. Whereas on the receivable, I raised an invoice for $100,000 when it was 90. Now it is 92. I will get 92. So that is the whole difference. Unfortunately, I have seen this as being error. They restate both, and that 2 rupees you will never be able to reconcile, because it goes and hits foreign fluctuation account. So that gets accumulated and it gets never reconciled.
It cannot
So
be.
try to manage those. Component accounting is again, it's more a theoretical concept. I have not seen much impact in the financial statement. What exactly they mean by component, wherever you see that, imagine you are a manufacturing company, you have a manufacturing plant where there is a feeding machine, there is also a packing machine, and there is a mother machine. So mother machine requires raw materials which is fed by a feeding machine. After mother machine creates the product, it goes to a packing machine, or let us imagine there is from the mother machine your products comes out. There are two types of products. One, treated product, and other is not treated product. When I say treated, means it goes through some chemical reaction, chemical activities, and final output is after chemical activities. So in this I have 3 components in one single product. For mother plant, the life may be 30 years. For a chemical treatment product, it could be 20 years. For a feeder, it could be a 10 years. So I need to make sure the feeder I am depreciating for 10 years, the chemical plant I am depreciating for 20 years, and mother plant I am depreciating for 30 years. That's again an important thing which we need to follow. Generally it happens in manufacturing. I have not seen much in IT companies. There won't be any much components. But one thing which we need to be aware, generally, if whoever is working on rented premises and you have taken shell from the landlord, you have built your infrastructure. Infrastructure could be as simple as cubicles and some equipments. The agreement is when you leave, you should give back the way it was. So you need to remove all the items. You need to give the shell back to the landlord. For doing that, I will spend some money. That amount I should capitalize when I capitalize my infrastructure. So I need to identify after 6 years when I leave the premises, I need to spend say 25 lakh rupees. That 25 lakh rupees I should accrue it today at a present value, capitalize onto the asset, amortize over the period. The entry will be debit fixed asset cost, which is asset retirement obligation is what we call in our India's language. Capitalize that, create liability, rather provision, and when I have to make the payment, this provision will be adjusted, it will be reversed and liability will be created. I will make the payment, depreciated over the period. Fine. Title deeds reconciliation, which we find in companies where they have multiple branches or multiple operations. Imagine a scenario, I am a manufacturer and I have multiple plants and each of the plant is in different location. The title deed should be in the name of the company. That reconciliation is again a very important task which also should get disclosed in Schedule 3 under the fixed assets. Primary closing checklist, what we have learnt. 1, you should have aging schedule. You should have fund flow analysis, again primary requirement thing. Under CARO, we need to comment how the fund is utilized and whether the fund is utilized for the purposes for which it was borrowed. Example, I am building a new plant and I borrowed say 30 crores. That 30 crores should be used for constructing or buying the new plant. As an auditor, I need to comment it is compliant. For an auditor to comment, accountant should have the fund flow and they have to give the workings. Now a small twist. Promoter, rather the plant cost 30 crore. Promoter had given an advance 5 crore from his pocket. Then the loan was sanctioned. Loan was sanctioned at 30 crore. This 5 crore, can I pay it to promoter? If I pay it to promoter, as an auditor, can I tell it was used for the intended purpose for which it was borrowed? This happens, right? So as an auditor, how should I comment? Is it compliant with the term of the loan or should I modify the report? Answer very clear. I need not to modify the report. If that 5 crore has gone to the plant, when I go to the borrower, I would have mentioned that 5 crore I paid. Please lend me 30 crore, that is for this project, and 5 crore promoter will take back the money. That's how the whole thing happens. You need to keep a documentation appropriately so that the payment from promoter has gone to the vendor, because you will have in the moment you have a plant, you will definitely have a project, and the project would have been shared, project report would have shared with the bankers. It should be traceable, and if it is traceable, it is good enough. Supplier finance I explained, audit trail I explained. Leases. AS 19 is simple. We do straight line basis. Take all the future payouts, divide by total number of months, average rent, amortize average rent over the period in line with the straight line. On the other hand, the issues will come if I am following Ind AS 116. In Ind AS 116, what we do, I will create right of use asset as an asset. I will create right of the liability as a liability. For right of use asset, I will also consider the security deposit. I will add the security deposit. By chance, if I have paid any commission to a commission agent for me to get the leasehold land, I'll have to add that also as part of the right of use asset, amortize over the period. Life is simple. All of a sudden, some changes happen. It so happens that metro comes near to my place. Landlord tells there is a escalation clause, and you had projected. The way it works is, I will sign a 5-year contract, 2 years non-cancelable, 3 years possible extension based on the mutual understanding. So what I would have done under Ind AS, I would have computed for 5 years. Now, after 2 years, the landlord asks additional 10%. So it is an amendment in the lease clause. That amendment, I need to bring it in my right of use asset working. I need to recapitalize and I need to amortize. GST reconciliation I explained. Couple of things under accounting standards. I did explain majority of the things over there. In revenue recognition, keep one thing in mind, the 5-step principle. 5-step principle is: 1, do you have an agreement? If you have an agreement, I mean contractual obligation is what I mean by agreement. If you have an agreement, next is that agreement talking about the consideration. If the agreement is talking about the consideration, also check whether the agreement has multiple obligations. If there are multiple obligations, what I mean, I sell a software. When I sell a software, I am selling license to you. I am also selling annual maintenance contract to you. I am also selling certain add-ons to that. If I am selling annual maintenance, the way it works is, first year is annual maintenance free, second year onwards you should pay X amount to me. So there are two components in the revenue: sale of a product, sale of a service, and those should be appropriately identified from the consideration part. How much of the consideration goes to the product, how much of the consideration goes to the services. And if the services are happening only after year 1, even though I have received money today, I need to defer it. I'll say an advance from the customer. I'll recognize revenue only after that particular period is over and the revenue will get generated. There will be difference between GST returns and my books of account. There will also be difference in 26AS, because that fellow would have done the TDS on the whole amount. It will appear in my AS, it will appear in my 26AS, but I am recognizing revenue only to the extent of product. For that balance amount, when I file my IT returns, I need to make sure I have carried forward the TDS portion. There is no way I can recognize the TDS, rather I cannot claim the TDS in the current year. I'll have to carry forward it to the next year. Whenever the revenue is recognized, adjust the TDS, rather claim the TDS and pay the balance amount. Leases I explained, ECL also I explained, AS11 I explained, employee benefit. One thing which I want to tell you here, under ESOP there are two methods: graded and straight line. In simple terms, if I have to explain that, straight line means the expense gets amortized more or less straight over the period during the vesting period, whereas graded means the initial year there will be a huge impact and the impact reduces over the period. Guidance note tells gradient is an option, so you have to follow accordingly. Read the contract, make sure that the compliances, rather the accounting, is in line with the ESOP contract. Then impairment, I think I explained. This CSR, let me spend some time on CSR. Since 31st March is over, if at all CSR is not completely done, Section 135 Red with Schedule 7 of the Companies Act, you need to spend minimum 2% of your average net profits on CSR things if you are liable for CSR. One of the simple provisions to say CSR applicable or not, your profit should be at least 5 crore. If you have not spent the money as on 31st March, you have two options. If it is a continuing, rather ongoing project, you have time till April 30 to transfer to a separate bank account. If it is not a ongoing project, the only option is you have to transfer to a specific fund and you have time till September for doing that. What is an ongoing project? Assuming I am constructing a hospital, that is my CSR obligation, and hospital construction takes definitely a longer time. It will take more than 1 year. I have started the activities. I had identified say 3 crore rupees towards CSR. I have spent only 1 crore. Balance 2 crore is unspent under an ongoing. That 2 crore I will transfer to a separate account and I'll keep it in the separate account. If the activities are just supporting medical, it is not an ongoing. If I have not done till 31st March, if I failed to doing within 31st March, then I am forced to transfer to a fund account. Another thing which I want to tell here, if I am making any payment to a Section 8 company, I being a company, then they should be eligible for taking the CSR fund. There is a requirement, one of the fundamental requirements is that entity should have a 3-year background of doing such activities. There is one exception. If the company is promoting a Section 8 company, I am a company and I am promoting a Section 8 company, I need not to look at that 3 years background. I can immediately give it to Section 8, which is my own group company. That 3-year criteria will not come into picture. That way it is beneficial. Another thing, whatever money I spend here, unfortunately, is not a deductible expenditure which has to be disallowed while I compute my income tax returns. Any question on this? So, couple of non-compliances which generally seen in practice. One, Caro applicability mismatch, which I have seen while looking at the auditor report. In the main audit report, they say Caro is applicable, but if you go there, they wouldn't have given Caro. So it would have been a copy and paste, they would have just done, but they know Caro is not applicable, they wouldn't have done. So those are the things which can be avoided. They use the word standalone financials, even though there is no consolidation. Sometimes people use standalone financial, that can be avoided. Profit or loss, this is something which I see in majority of the cases. The company may be incurring losses, but when an auditor issues the report, by error, he will mention as profits for the period. That also matters a lot. Board's report comment, which we keep seeing. As an auditor, we need to comment on the information which is given in the board report. And at the time we close the audit report, rather financial, board report might not have come. If the board report has not come, please be conscious to say board report has not come and I am not in a position to comment on the same. If board report has come, please look into the things that the numbers or the quantity information what they are giving there in the report is matching with what you are signing as a auditor on the financial statement. Audit trail I explained. IFC deficiencies, many of the times few auditors, or rather we miss updating the comments on the IFC. There is a beautiful guidance note which is issued by Institute of Chartered Accountants of India, which explains how the comment has to be made, what kind of testing has to be done. Please note, I don't know how many will be aware, any idea how many samples I should take when I do IFC testing? Is it mentioned anywhere in any of the audit sampling standard? The The answer is there in guidance note on IFC. It tells if the transactions are happening once every month, for such things how many samples you should select. If the transactions are happening on a quarterly basis, it tells how many samples you should select. Like that, it has given a beautiful table. Just follow that. That will give you a better picture. If you have that many samples for testing the IFC, that is good enough. Related party transaction, again, identifying promoter group is a challenge. Please look into those. Going concern assessment has to be done on a regular basis wherever there is a loss. Internal audit reports, wherever internal audit is applicable. Internal audit is applicable the moment turnover is more than 200 crore if it is a private limited company. Please, and subsequent year, internal audit is applicable. Statutory auditor has to comment on that. It's not that internal audit should always be outsider to be done by outsider. It can also be done by internal team, the company's team. If that report is available as an auditor, you can trust those provided they have followed certain basic covenants of internal audit requirement. Few tax linkages, of course, tax thing will be happening in the subsequent thing, but few things as an auditor which we should be aware. We may sign the statutory audit report before TP certificate get filed. Majority of the cases that happens. Please be mindful to bring a note in the financial statement telling the TP is in the process. We have reviewed the activities and we don't see any challenges on that. TP documentation for the current year definitely will be pending. TP documentation for the current year will come only after whether it is Proves or Capital Line gets updated. Those two guys update only after the companies file their annual return, and that happens at a later stage. This note will help you out. Second, wherever there are segments, be very careful. Segment documentation should be confirmed by the TP auditor. He should confirm that segment documentation, and that should come in the financial, because you are in captive entities, margin depends on the segment which you are working. Another thing which I want to share with you guys, in the current budget, Madam has proposed the safe harbor rule, which is a beautiful amendment which she has proposed. Whoever falls under the bracket ecosystem IT enabled services, at least I am taking a stand. I am pushing them to go to safe harbor. Safe harbor today for ITS is 15.5%. Once you go for safe harbor, your life is fixed. Rather, for next 5 years you are safe. The way it works, 1 year, first year assessing officer will do a diligence, or he review the document to confirm that you literally fall under ITS, and once he confirms, next 4 years there should not be any assessment. So your life is like for 5 years you are 15.5% or whatever that rate, it is fixed. You are safe, your parent is safe. There is no requirement to go for APS. Majority of the case, whoever has gone for APS and their turnover is less than 2,000 crores and they do not have much of the companies other than India outside, they are coming back to the safe harbor. But APA is again beneficial if at all you have multiple countries. Along with India, assume you have Australia, you have Germany, you have Middle East countries, then APA may be better. Otherwise, safe harbor could be a better option. Issue of shares at premium, multiple challenges will come. There will be a valuation requirement that has to be taken care. Depreciation, we see the rates very important. An item can be wrongly considered as a computer, because in Schedule 3 for us computer is a vast definition, whereas in income tax it could be restricted. Be careful on those. 40A again I see disallowances. ESOP, taxation is very important. You have to do taxation based on the fair valuation the moment exercise is done. No need to bother during the vesting period unless exercise is done. So what we generally advise is to keep the exercise at the last moment so that there is no impact on the taxation. Deferred tax, what we see in deferred tax asset, opening WDV or closing WDV, what you have does not match with the ITR. In ITR you have a separate WDV, whereas deferred tax you have a different WDV. Interest under 234B and C. Many times even I have failed, I have missed 234B and C. We don't accrue in the books. Even though there is a liability, it gets accounted in the subsequent year. Try to avoid those. From the GST side, GSTR 1 and 3B reconciliations, RCM very important. Wherever there is import of services, the best way to do is go to the schedule 3, check what is the payment done in foreign currency, cross check whether GST is done on such imports, and if GST is done, that is good. If there is no GST, please make sure that has been compliant. Again, TDS will come into picture over there. Export compliance, the exports versus actual receipts versus the accounting has to be taken care. And effective April 1, of course, new document series should start. 180-day rule. In trade payables, we will be showing dues for more than 1 year. The moment you have dues for more than one year, the immediate question should be, have I reversed the GST input on those? If I have not reversed, again there could be a challenge. Few other things which will come: balance confirmation. Many a times I see some comment in the financial, the balances are subject to confirmation and reconciliation. Please avoid those. That will become a very big issue. And try to get the balance confirmation and reconcile those, a primary requirement. Revenue versus 26 years reconciliation is again mandatory. Under gratuity, which we need to check is what are the assumptions they have taken. If the assumption tells that as per my company retirement is at 58 years, but the assumption tells retirement is 60 years, again it's a error. We cannot do such mistakes. I know in my company the hike is happening at say 10 to 12%, but they have taken 6 to 7%, which is an industry average. Again, those are the assumptions which we need to be careful, because it has an impact on the actual gain or loss. Deferred tax working, certain items which are, the way we do deferred tax workings, how the thumb rule which we follow is, there is something called effective tax rate. Go to the P&L, see the total of income tax and deferred tax. Imagine that divided by PBT. If the total, if that rate comes to around 25 or 26%, then your deferred tax is fine. If that effective tax rate is either below 25% or above 26%, then that means there is something which has gone wrong in deferred tax workings. Because that difference, the way it works is, whatever I have disallowed under income tax, I should have created a deferred tax credit. If I have failed doing that, my effective tax rate will never be 25 or 26%. 25, 26 it is coming because if I have taken 22% tax rate, add 3% or cess and add surcharge, it comes to 25.23 or 3%. Keep that as a thumb rule. MSME interest, dues are more than 45 days. The contract says credit is 60 days. Promoter say I don't have to pay interest. Please be aware, even though contract says 60 days credit, MSME law tells it has to be paid within 45 days. You should accrue interest 3 times the bank rate for the delay. So that should be that should be considered. That will also come under 43B small h in income tax. The interest is disallowed. Liability is, interest is disallowed as a permanent disallowance. Liability is disallowed under 43B, which will be allowed only on actual payment. CWP aging we discussed. Previous year figures, sometimes they reclassify the financial, they miss to reclassify the last year numbers. Last year I had shown say one component of salary under other expense. Now I reclassified it to employee benefit, but I failed to reclassify the last year numbers. So the comparatives are not comparative prima facie. So few analytics which can be kept in mind. Whenever I do IT companies, I keep a track how much is the salary to turnover ratio. I also keep a track when I do manufacturing for COGS ratio. That has to be kept in mind. Depreciation to gross block is again a very important thing which can actually, this analytics can actually act as a major field work. Whenever the financials comes to me, the first thing I look at is I take the calculator and see these primary analytics to see whether the financial statement has gone any mistake in the financial statement. Rates and taxes to revenue, again we can do that. In cash flow, I look for non-cash items and try to reconcile with the books of account. PF to actual salary. PF to salary should be somewhere around, if I remove other components, it should be 12%. Keep a track year on year. If the numbers are fluctuating, that means that there is an error. Finance cost to borrowing, again a good ratio which we need to check. Tax effective rate I mentioned. So I think the last one, documents which we need to keep for confirmation: close calendar milestone, reconciliations, revenue cutoff, provisions are documented, GST and 26A is reconciled, related party transactions are identified and reconciled, audit trail is identified, POS and maternity data is confirmed, supplier finance is appropriately disclosed, all prior year adjustments are identified. Whereas documents to prepare, make sure there is an actual valuation, there is inventory workings and NRV workings, fixed asset register is matched with the depreciation schedule, rule 11E is taken care, wherever audit trail is required, it is screenshots are taken. So I think this was something about which I wanted to discuss. Any question, any query, I think we have another 5-10 minutes we can discuss.
The interest will be accrued. In that case, that interest will be paid to the vendor. In that, if you like paying the interest to the vendor, then again the TDS provisions will be there, 194A.
It is, see, it is interest for non-complying with the terms. You can argue it is not 194A, but generally I suggest you pay it off. And also, the question will be on GST part. Is it loan or is it payment terms? Again, GST has a different view on that. So better to pay TDS. Life is simple.
Thank you.
Good. Thanks a lot. Thank you very much for the patient hearing. Hopefully I conveyed something, and wish you all the best for the new financial year. With all these changes, I'm sure our profession is going to sustain for very long. So few things which I keep telling my team: invest good time on technology, invest good time on all the tools which are available, whether it is AI or various other tool, which is going to help us. The time which to be spent will definitely is gonna reduce. Let us have our system so strong though that it is not dependent on one person. The organization runs on a long run basis. Thank you all. Thanks a lot. ಕೊಡ್ತೀರಾ? ಇದು ತೆಗಿಲ್ಲ? ಓಕೆನಾ? ನಂದಿದ್ದು ತಗೊಳ್ಳ.
ಒಂದು ಔಟ್ ಆಫ್ ಟೈಮ್ಸ್ ಕೊಟ್ಟು ಹೌದಾ? Yes, I thank you, CA Vikram Udupi. That was, I'm pretty sure it was a wonderful session. I request CA Kavita Parmesh to come on the dais and hand over memento for the today's speaker. Thank you so much. So please do attend the next sessions also, which we have started as a new series, year-end closure series. So thank you so much for all the active participation.